Yeah, absolutely. No problem. And perhaps we can then load the presentation and just pass control across to me.
Yes.
Welcome, everybody. Yeah, apologies that you're not able to have your usual face. David Coombs here. Hopefully I'll be the acceptable replacement. Just a couple of seconds on my background. So I've actually been with Rathbones almost 16 years to the day, which is quite terrifying in itself. I joined relatively straight out of university. I joined the charities team there, where I focused on large multi-asset charity mandates, and then came across to join David in 2015, where we've spent the last 7-8 years now building up that franchise. And yeah, I was sort of the number 2 with him, and then became a co-fund manager on the funds for the last, I think, nearly 4 years now. So I'm not sure any of you have heard of me before. I can see Peter's got his hand up. No? Okay, good. Yeah, I'm not sure any of you have heard from me before. I think you do normally get David, but certainly the Abbey guys have plenty of times over the last few years. So we've got a presentation which I'll run through, which will be a sort of generic update on what's going on. Clearly, lots of big moving parts, which are quite important to discuss. If you've got questions, I think Ian, normally there's a Q&A session at the end. So if you can generally hold fire. If you've got something really burning, quite frankly, you feel free to interrupt me. I don't mind taking them as we go, but they might be better off having them all at the end. So with that, I think hopefully we can get the presentation up and I'll dive straight into it. Oh, as that gets loaded, I'll just start anyway. Yeah, perfect. Here we go. Thanks, Ian. So realistically, if you go back, 15 months, which is really since all of the pain has been felt. And this is the key reason why it is rates going up, and rates going up faster and further than any time in bond history. So that won't be news to any of you, I'm sure. And that is slightly out of date. Fed funds rate is even higher than that now. And of course, it went up another 25 basis points last week. And this is increasing the cost of money, the cost of everything. This is what everything prices off. And as the risk-free rate reprices higher, so everything has to move higher. And that is because if once upon a time you invested in bonds, you invested in equities, and in your bonds you were getting 2-3%, your corporate bonds maybe you're getting 3-4%. Of course, now you can get 3-4% cash. So you don't need to take any risk at all, in theory, by having money parked at the bank. And of course, we'll come back to talking about having money parked at the bank in light of what's been happening both in the US and Europe and in the sort of mini banking crisis that we've had. But the crux of the problem has been this, seeing those rates go up so significantly. And there have been 2 main reasons why this has been happening. One, because quite frankly, we've been at 0 rates for a very, very long time prior to this. And when that happens, bad things tend to happen, and you can get these sort of mini bubbles in various pockets of the market, which we've seen, I think probably highlighted best by what was happening in the crypto market, in NFTs, and in some of these startup SPAC valuations that we saw at the back end of 2021, where you were seeing these companies, some of these companies priced at ludicrous levels. I often think one of my favorites was Nikola. Don't know if any of you have come across Nikola. That is an electric truck company, which at one point in 2021 had a $40 billion valuation, despite having 0 revenues. It had a few orders, but it didn't even have a working prototype. And it was actually called up by the marketing authorities because for its advert that it ran, it had to roll its truck down a hill. Because it didn't actually have a working prototype. And so clearly, when you've got a business like that with a $40 billion valuation, things are not quite right. And I think the Fed was starting to take steps to address that when they started raising rates and started talk about raising rates at the back end of 2021. which is the point at which you started to see bond yields around the world go higher. And of course, the second thing, if we can push on to the next slide, which is the thing that unfortunately we've been forced to talk about over and over again for the last 15 months, is inflation. And of course, as you'll be all familiar with, we tend to go through these cycles where we end up talking about one crisis after another. And of course, it was Brexit, for those of you UK based, that we were talking about for a very long time. And, you know, I was desperate not to talk about Brexit anymore. And of course, then ended up talking about COVID for 2 or 3 years, which was even worse, I think. And now it's inflation, where we've been focused on for the last 2 years, and what markets are, you know, laser focused on. And that's because we've had inflation spike to levels we've not seen for a very, very long time. They're, of course, not unprecedented. We have been here before. And the cause of this has been, you know, the complete disruption to both demand and supply that COVID inflicted. You know, you had supply chains completely shut down. You had parts of demand completely turned off. And then you had the complete reversal of that, whereby everything opened back up and people were sat at home and they got paychecks sent to them, and they were they were placing their orders online for all sorts of goods, and the supply chains were not back online, and they were not in a position to be able to pick up that slack and service that demand. And so you had a classic, you know, what you get is where demand is higher than supply, you obviously get inflation. And it wasn't helped, of course, by the fact that rates were very low. But a combination of that, fiscal policy, I think someone's just come off mute, if you wouldn't mind going back on mute. Fiscal policy, mainly in the US, where checks were being sent out, but not only in the US, you know, anybody who lost their job were, of course, getting both unemployment and sort of COVID furlough benefits in the UK, is what we were calling it. And many people in the US were actually better off, you know, on their furlough benefits or on their COVID benefits than they were actually in a job. And of course, as a result, you know, you had goods prices going up. You then had the energy crisis as well. You know, this was a situation where I think probably inflation would have been getting back to normal comfortably by now if you hadn't had this added kicker of energy inflation. And of course, you know, there was an element of it there already, but as soon as Russia invaded Ukraine, you saw energy prices go through the roof. And of course, that immediately pushes up costs for everybody. Just thinking about the petrol that goes in your car, just thinking about, you know, the cost of heating your home, but it also pushes up costs for companies. And of course, if you push up input costs for companies, they then pass that on. And so you get that immediate impact on inflation from energy prices going up, but you also get a lagged input where everybody who is feeling the pressure of those energy increases then has to pass that on into their final goods, into their services inflation. And so you get that pushing on. And so what we've had, as I say, is this huge shock to the system, this huge inflationary shock to the system. But that is starting to ease off. And you can see it now in US core inflation on the left-hand chart here, where the advance you can see was the smallest in over a year. So that is starting to come down. You've got goods inflation, which is coming down. Food inflation is still an issue. Services inflation is still an issue. And then the cost of what they call in the US shelter, which again is a lagging issue, and that is starting to come down. So I think by the end of this year, inflation is going to be materially lower. The possible fly in the ointment is wage inflation, and that's the one that we're all looking to in the US. We're looking at the jobs market and trying to work out how sticky that wage inflation is. The fact is we are starting to now see job losses in the US. They're getting announced on what feels like a daily basis. And of course, UBS have just announced they're going to be 11,000 job cuts from them having taken over Credit Suisse. They're happening in the tech sector. So they're not necessarily happening in the right areas, ironically. You know, some of the problems have been in the lower income jobs. But I think as time goes on, that will also cool. As the unemployment rate ticks up, wage inflation will have to come down. The other slight difficulty, of course, is as we went through COVID, you had a dual impact on the labour market. So I talked, of course, about the impact on goods, the impact on services, on energy, but you also had this big impact on the labour market, and that is because millions of people retired early. People in their 50s decided that they'd had enough. COVID was the final, final bullet, as it were, and they thought, right, I'll take early retirement. And their pension pots were probably looking pretty healthy. Cost of living wasn't too bad. And of course, the question is whether we get a few of those people coming back now that the cost of living has gone up significantly. Pension pots are possibly a bit lower. Maybe a Bitcoin portfolio isn't looking quite as healthy as it was at the end of 2021. Not me. Good. Well, hopefully some of you came out of Bitcoin and crystallize your gains. But the other problem with the labour market, and I think is something that people are struggling to understand how much of a material impact it is long COVID. And a lot of people are off work because of health issues. Now, whether that's tied to COVID, whether that's tied to, in the UK, certainly pressure on the healthcare system, of course, which has been significant over the last 2 years because of COVID. No one can be quite sure, but there are estimated to be anywhere in the US around 5 million people out of the workforce because of health-related issues. And the question for me is, how many of those are able to come back? Is this a case of many of those over time will get better and can come back into the workforce? Are they going to be on permanent disability benefit? And so we've got a significantly structural, tighter labour market than we've had for a very long time. Perhaps there'll be some medication which will come through, which will help people get back to work. These questions I don't know the answers to. It's something that we have to be wary of. But right now, I do think that as we start to see those job losses announced, we are likely to see some easing in wage inflation. And of course, you might look at around the US and say, well, things are starting to slow. Some of the data we've seen coming out of the US is starting to slow. Inflation looks like it's starting to roll. We've had some bank crises, which I'll come on to. So, why are the Fed still raising rates? And the answer is on the right-hand slide, because they are still scarred by what happened in the 70s, which is when we had this big spike in inflation. So that's the dark line in the mid-1970s. And what happened is inflation came off. The Fed thought they'd beaten inflation, and so they cut rates. And of course, what you then saw is a re-acceleration in inflation in the sort of late 70s, early 80s. And ultimately, the people pointed the finger and said the Fed had cut too early. They'd made a policy error and allowed inflation to come roaring back. And so that's the concern for the Fed. They don't want to make the same mistakes again. That, I think, is why they've pushed rates up another 25 basis points just recently, despite some of the issues going on at the moment. And that is why we as a team think that we are unlikely to see rate cuts before the end of this year. So the market is expecting rate cuts at the back end of this year. I think that is unlikely. Now, that's all well and good. But, if we see some kind of crisis, a material turn down in growth, then obviously we could see some cuts down the road. But I think the reason why, on balance, the Fed's unlikely to cut is because of this reason. Until we see inflation materially down and staying down, I think they'll be hesitant to cut rates. And so that's going to keep rates elevated for this year, and that's probably going to keep things quite tricky for the rest of this year. If you go on to the next slide, you can see that the problem that we've had with rates moving up so quickly and to such a high level is it creates problems elsewhere. Whether that was, the crumbling in overvalued assets that I mentioned earlier. So you had, the fall in Bitcoin and a number of cryptocurrencies that have gone under, as well as the trading platforms. The slide in the middle talks a bit like to what I was talking about, Nicola. That is a slide for flying taxis, of which I think you had 3 flying vehicle companies IPO in 2020 or 2021 at multi-billion-dollar valuations. Again, really, these were concept businesses for me. They were startup VC type businesses that realistically should never have come on into public markets. But people saw the overvaluation in pockets of the market as their opportunity to sort of exit and take some money out at these higher valuations. The other issue that we've clearly had has been this mini banking crisis. I say mini, I mean, it's verging on major, but it has not been systemic, and that's been the really important thing about it. Just to give 2 minutes on that, because I do think it's important. I don't know how many of you are familiar with SVB or Silicon Valley Bank and what was happening over in the US recently. But ultimately, and I'll try and summarize this in a couple of minutes because I don't want to go on too long. I did talk about this in our podcast if you want to log on to that and get a bit more of an in-depth explanation. But the long and the short is Silicon Valley Bank. So the US is 16th largest bank at the time when it started to run into problems. It had grown its deposit base massively, and that's because the majority of its clients were these sort of startup venture capital type businesses. And SVB specialized in lending to them, taking their deposits. And of course, so much money was flowing into these startup businesses that every 6 months or so, a company got a new infusion of $100 million, $500 million, which they put with Silicon Valley Bank. And of course, their deposits got bigger and bigger and bigger. With rates going higher, these businesses have struggled to raise more money. They've been burning through their cash reserves. So what happened was that money was coming out of Silicon Valley Bank. So it wasn't a sort of traditional bank run, but it almost acted as the same thing because all of its clients were taking money out at the same time because these companies, they're loss making. And so they need to pay for their ongoing activities, but they're not getting any new money infusions coming in. So all of that money came out of the bank. Silicon Valley therefore had to sell the assets that it held against those deposits, and those assets were bonds. And unfortunately, they bought a lot of those bonds when rates were basically zero. So they had big losses on those bonds that they ended up crystallizing. That led to them trying to raise more money to pay for those losses, which spooked the market. And then ultimately, everyone then got worried that this bank was going under, and every single CFO, including a friend of mine of a venture capital business, said, hey, I need to take my money out of Silicon Valley Bank before it goes under because I've got $10 million with them and I'm only insured up to £250,000. So if the bank goes under, I'm going to lose.
Will, have you gone on mute? I can't hear you anymore.
Sorry, I just got a notification. So somebody muted me. I don't know how that happened. Anyway, I hope you didn't miss too much of what I just said there. But yeah, ultimately, so all that money coming out, had to sell those assets, making losses. People panicked, and then all of that money flooded out. And I think they lost something like 25% of their deposit base in 2 days. And to give you a comparison, the last US bank that went under was a company called Washington Mutual, who lost 10% of their deposit base over about 3 weeks. So the speed at which that money came out is something that has never been seen before. And of course, it highlights how in the new sort of tech world that we live in, because people don't even, a bank run doesn't now have lots of people stood outside the branches. People get on their phone immediately and transfer that money out as quickly as they can. And it really just highlighted how the risk of a bank run and how quickly it can happen is perhaps elevated in a more technologically advanced world. So you have SVB going under. Yes.
Can I just jump in? I mean,
Absolutely.
is what they were doing with clients' deposits sort of legally wrong, or was it were they simply stupid?
It's a very good question. It was badly managed. So a lot of banks have bought some of these bonds, but a lot of them also hedge that interest rate risk. Because, as I say, I don't want to get too technical, but ultimately, if you've got deposits, they're very short dated, right? And so they can go very quickly. And so what you should be doing is, if you're buying longer dated bonds, you need to hedge that interest rate risk, which is what most banks do. SVB did not do that. And now technically, it's not a problem as long as those deposits don't go out of the door. And for most banks, that's very unlikely to happen. Most banks have a very sticky, retail heavy deposit base. And banks are very well capitalized, right? So some of the sort of regional banks that have had an impact from this, because people started to get worried about the regional banks, they've got very strong balance sheets. This is not 2008. We've got a very strong banking system. But the problem is when you get a bank run and money goes out the door, it, very, very quickly it creates problems. And of course, you saw Credit Suisse go under, or say go under. They got bought out, but for all intensive purposes, they basically went under. So that's big. Swiss bank, Credit Suisse, got bought by UBS ultimately for a pittance. Certain bondholders lost all of their money in the sort of very lowly rated ones called COCOs. Again, won't get too caught up in the technicals of that. Credit Suisse, I thought, was particularly unlucky. So they've been through all sorts of problems, Credit Suisse. Again, it's not a particularly well managed bank, but the balance sheet was relatively strong. But for various reasons, they've been seeing money coming out of Credit Suisse, people leaving Credit Suisse simply because it doesn't provide a very good service. It's had a lot of problems with its investment bank. So money was going out, but a lot slower in this particular instance. And then you had the head of the Saudi National Bank, who have a 10% stake in Credit Suisse, say they weren't going to put any more money into the bank. And bizarrely, that led to a big panic around Credit Suisse. Depositors then got panicked and started taking their money out at a quicker clip. And of course, Credit Suisse is much more important to the financial system. It is a big global bank. It is a systemically important bank. And so the Swiss authorities stepped in and did what they needed to do to shore that up. And the end result of that was UBS, its big peer / competitor, buying Credit Suisse. I can't remember how many billion. I think it was something like 3 billion. Interestingly, it went for 3 billion. I think the market cap had been 65 billion about a week before. So if you're an equity holder, you didn't do too well out of that takeout. So skipping on to the next slide, I want to make sure I leave a bit of time for questions. We talked about bonds and the problems for those banks who had owned bonds, which they bought at zero yields. This has been the problem for bonds. People have historically looked at gilts, US treasuries as the risk-free, safe, secure part of their portfolio. And from a credit perspective, that is exactly what they are. If you lend money to the UK government, if you lend money to the US government, you're going to get your money back. You're very, very, very unlikely to ever see a default from a Western government, particularly one who has control of their own money supply. And what you can see here is how, whilst you get your money back, in the short term, your mark to market can be very, very nasty. And that is, if you bought a UK gilt at the start of 2022, you can see it was priced at 300. Apologies, that's very small. It's priced at 100 there. By the end of the year, that was priced at 54. So your sort of safe, secure asset had halved in value over 1 year. You can see that reflected in the level of yield on the right-hand side, whereby, and of course, yields went even lower than that through the Truss weeks, when that mini budget was, of course, announced, and markets panicked about the big black hole that the UK balance sheet suddenly looked like. I'm not sure if you can change the sidebar in, but anyway, the long and the short.
How to. Apologies.
Yeah, don't worry. This is the last slide anyway. I think that's particularly small. But the point is yields hit 5% at the peak. They have now come down materially. But that safe, secure part of the portfolio, I think, is where a lot of people got caught out last year. Anyone who owned these bonds, you know, particularly in lower risk funds. So in lower risk funds, you know, people often hold gilts, they hold corporate bonds. They're supposed to be the more defensive element of the portfolio. For us, we had very little exposure to this space. You know, in many of our funds, we have zero in gilts, we have zero in US Treasuries, we have very little in corporate bonds. And so from that perspective, we navigated last year quite well. And for us, that was because with yields so low, and if you recall, there was a period over the last few years where you could lend to the UK government for the next 10 years and get 0.2% a year for the next 10 years. So say from a credit perspective, you're going to get your money back. From an investment perspective, why would you lend to the US government for 0.2% for the next 10 years? You know, that is a long time frame to tie up your money when you've got concerns around inflation for a start. You know, it just seemed crazy to us. But the fact is people were in panic mode. There was a lot of liquidity swashing around the system. We had rates at zero. And so, you know, that was where bonds were priced. And so we didn't feel like that was a sensible place to park our money. So instead, we actually ended up holding a lot of cash, which was also yielding zero. So it wasn't a great return, but that cash has, of course, at least held its value. Whereas you can say if you were in 10-year bonds or 30-year gilts, you took some quite nasty pain in asset prices there. I've got a little bit on the UK, which I'm going to keep relatively quick. The UK has obviously been under a lot of pressure for a number of years now, really, ever since post-Brexit. You can see here that, you know, particularly with, well, if you're a UK household, you've had energy prices going through the roof. Now, of course, there's an element of that being capped, which is about to potentially run out. But even that cap has still allowed people's energy prices to go up significantly. And this is not clearly just a sole UK problem, but it is a major problem for the UK. You then, of course, on top of that, have mortgage rates going up because the Bank of England's been hiking rates. And so if you now, of course, you've got to think a lot of people are on short-dated fixed mortgages that are rolling off. So we've not seen the full force of the rate hikes yet. You will start to see that over time as people's fixed mortgage rates roll off and they have to go on to a higher level. And of course, that means their monthly mortgage payments go up significantly. Food price inflation is going up significantly. So for your UK household, and particularly, unfortunately, for those at the lower end of the income spectrum, this is particularly painful. Now, Rishi Sunak, to be fair to him, you know, he's also facing problems with strikes. And of course, with inflation going through the roof, you know, all these unions, of course, pushing for higher and higher wage hikes. The UK government pushing back because they're wary if you get big wage hikes, that sort of feeds through to inflation. It then becomes almost self-reinforcing. So I think to a certain extent, they've sort of been biding their time trying to allow inflation to drop down. So their bargaining position becomes a little bit easier. But nonetheless, you know, been some pretty significant problems for the UK. And the question is on the next slide, whether things are just starting to turn. Of course, you've had this Windsor Framework Agreement. You know, it does look like certainly the UK is starting to get its house in order. But you've got various issues still the UK is going to face. As I say, those costs to UK households aren't going away. You've got the various tax changes that have been made, which aren't necessarily pro-growth. You know, the Windsor Framework, I think, does help, and it's good. I mean, I can't really believe that 7 years after the vote, we're still talking about Brexit issues, which are still being ironed out. And I read recently that part of the Windsor Framework is they're going to spend the next 5 years working out which goods going into Northern Ireland are going to be vatable or not. So unfortunately, this isn't something that's going away quickly, but it does just slowly look like we're starting to get a little bit more clarity. Of course, from a UK market perspective, things aren't particularly healthy. The UK is doing okay in terms of the FTSE, but lots of companies are slowly leaving the UK market. They've been switching across to the US. This was particularly highlighted by Arm Holdings, which came back to market. People thought it might be IPO'd or listed, sorry, on the UK market. Instead, it's going to end up listed on the US for various reasons around disclosure. But I think it just highlights that the UK market seems to be a less attractive place for businesses to list, and that is something that I think the government needs to address and try and change and bring businesses back to the UK, because we are in slight danger of becoming something of an investment backwater. Now, it's not where we are yet. You know, we are still clearly a very important market, but over time we are becoming smaller and smaller. And if you look at the makeup now of the UK, the FTSE 100, it's very, very concentrated around banks, oils, mining, consumer goods to a certain extent, with staples, things like Unilever, and then the pharmaceutical industry. So some great businesses, some great global businesses to pick from, but increasingly becoming sort of concentrated in a handful of sectors. And, you know, realistically, only a handful of large companies when you think about what the global universe offers. And, you know, since we, you know, if you look at our portfolio, we are very much a global portfolio. You know, we take our investment ideas, you know, wherever they are. We quite frankly, we don't care where a business is listed. We just want good quality companies in our portfolio. And so we have a very, you know, we do not have a UK bias in our portfolios really at all.
So, Will, just to jump in, what sort of percentage would you say across your three core portfolios, what you have in the total return, strat growth, enhanced growth to the UK?
Well, I mean, I don't know about, if I just take strat growth to keep it simple, we probably got about 10% of our equity portfolio in UK equities. So that is probably still technically an overweight to the UK if you think about the global market. I think the UK is less than 5% of the global market now. It might even be down to something like 3 or 4%. So it's a slight overweight, but it's very much not the sort of 30-40% in UK equities that you can often see in portfolios. And just to be clear, we do currency hedge in our portfolios because we are wary of the fact that our clients, you know, need to be invested in their base currency. And so we hedge back. Now, of course, you're international, so we've got lots of various hedge classes that you might be in, whether that's dollar hedged, euro hedge. But we are managing that currency risk, which is the point. So if we've got lots of US companies, we will hedge some of that back into the base currency to make sure that you as investors aren't overexposed to currencies outside of your base. So then just really maybe to summarize, because I want to leave plenty of questions. So on the next slide, you know, what we've been focusing on in terms of the types of companies that we want to own, you know, those with low debt. As you've seen interest rates rise, companies with high levels of debt are going to see their costs increase. Now, many of those would have fixed that debt, and that's fine. And if they fixed it out for a very long time, that's okay. But many companies will have debt that will need to be renewed this year. And if it's high levels of debt, the cost of that is going to be a lot higher. So we don't want companies with high levels of debt. We want companies with big margins. We like companies with big moats around their businesses so they can protect their businesses. They can increase prices if they need to be. So that goes to the point about products and services with resilient demand. If your product has resilient demand, it means that if you are seeing inflationary pressures, if costs are going up, you can push that price up and pass it on to your end customer and protect your margin. And we do think that's really, really important. And we also like sensible capital allocation. So that talks about really strong management teams. As I say, we often find those in the US, and companies, you know, that are allocating the right areas. So, you know, not making stupid acquisitions, not, you know, investing in blue sky innovations that never end up coming to market and just end up costing a lot of money. And then just on so that's sort of where we're trying to focus on the equity side. And then just finally on slide 9, you know, this is how we've been thinking. So duration to be a bigger player. So this is talking about where bond yields are going to end up. And I talked about rates probably peaking about here. You know, we've hit 4.25, I think, in the US. Sorry, a bit higher than that, 5.25. I can't see them going much higher. I think you're starting to just see a slight slowdown in data. I think the jobs market is clearly starting to cool. I think that will feed through into wages. I think overall inflation will start to come down. And so I can't see why rates go much higher from here, if at all. As I say, markets talk about cuts at the back end of the year. For me, I think unlikely for the minute unless we are to see more problems. And of course, one of the big issues is, and this goes back to the old Warren Buffett phrase talking about liquidity, and when the tide goes out, it's only when the tide goes out that you see who's swimming naked. And the tide is going out, the liquidity tide is going out. And you've seen that, you know, an SVB, Silicon Valley Bank, you know, swimming naked. You know, they've not managed, to Ian's point, you know, they've not managed their balance sheet as sensibly as they should have done. Again, plenty of these startup businesses who are just burning through cash, they're now not able to get that cash to continue their loss-making operations. And so those ones that don't have a real future are going to start to go bust, going to start to go under, because, you know, they've not got to a position they need to be in. And I think there's been a lot of misallocation of capital in the venture capital space that potentially you're only just starting to see the problems with. And as I say, hopefully the banking crisis looks like it's been relatively contained. As I say, most banks have very strong balance sheets. However, as I say, when liquidity goes out, there is always the risk of these types of blow-ups, and it's something why we're playing an element of defensiveness in our portfolio, making sure we focus on very high quality equities. We've built up our position in US Treasuries, so that's something we did last year. As yields were rising, we found those bonds starting to look attractive, and as yields went above 3.5%, you know, we started picking up those bonds, you know, in fairly significant size, with a view that you're now getting paid 3.5%, 4%, you know, to lend to the US government. You know, I think that's relatively attractive for the next 10 years, particularly as that bond can now play its defensive role in portfolios. When yields were at 0%, it was a risk to my portfolio. It wasn't providing me with protection. When yields are at 3.5%, 4%, they look more attractive. It can really provide me with that risk-off asset in a difficult environment. Credit, so corporate bonds was an area we own very, very little of. This, of course, where you lend to corporates, lend to companies. We picked up quite a lot of bonds through the trust weeks. That was a period where yields went through the roof, both on a government bond level and a corporate bond level. So that meant that we were then able to lend to companies paying us 7, 8, 9, 10% for the next 3, 4, 5 years. Again, we felt that was pretty attractive, and so we put quite a lot of our cash to work through the sort of summer and autumn of last year. That has reversed quite significantly. Those bonds have become you know, a lot less attractive, so we've just sort of lightened up our position there. I talked about the hedge. The other thing that we use is put options. I don't know if you're familiar with those, but ultimately this is sort of an asset that's almost an insurance policy on our equities. So we can pay a relatively small premium to buy a put option, and it means that if equity markets fall significantly, that put option is then worth, you know, a reasonable amount of money. And the best way to think about it is, you know, insurance on your car. You know, if you bump your car and, you know, incur a £10,000 bill, that put option will help pay for that. And of course, if your car's a complete write-off, you know, the insurance contract helps pay for that. So if equity markets have a big bump or a material sell-off, those put options will just help protect the portfolio should things get a little bit more difficult. And then maybe just 2 minutes on slide 11, actually, because I've talked a lot about the macro. I just wanted to talk, sorry, the next one along, I just want to talk a little bit about companies, because I'm always wary, it's always easy to sound a bit negative in the current market environment, but actually we think, bonds are now pricing a lot better. Equities look reasonable, albeit maybe slightly expensive, given things are starting to slow, but we still think there are plenty of really interesting opportunities, in the names that we're invested in for the medium term, and that's whether that's looking at the health side. So for us, a lot of our portfolio is invested in sort of medical technology businesses or pharmaceutical businesses, which have really strong trends just from demographics. So people getting older, people living longer, people taking more medication. As medication improves and has better patient outcomes. And, unfortunately, as a globe, really, certain in Western nations, we are having something of an obesity crisis that is causing a lot of diabetes. And so we have names like Abbott Labs and Dexcom, which have specific glucose monitors, which are non-invasive, which we think are, really, really positive for patients in terms of managing their issues without their glucose getting out of whack, without the insulin getting out of whack. And it means that, again, it hopefully reduces hospitalizations, helps people live longer, healthier, happier lives. And those are systems that are being rolled out across the US healthcare system. Actually, I saw a couple of Dexcom adverts in the UK, so that you can see that they are expanding internationally. Climate change is an issue. We think, again, a really interesting area where we can invest in companies that are helping to solve problems. An example might be SIG Combi Block or SIG Combi Block. They are sort of a rival to Tetra Pak, who might be a business that you've heard of, which do those sort of aseptic cartons that you either get oat milk in or non-dairy milks in, or Covent Garden soups in, things like that. That's what SIG Combi Block do, and of course they are taking material share from the plastic market, whereby consumer goods companies no longer want to put their products in plastic, because there is increasingly a plastic backlash. Companies are looking to manage their carbon footprint and improve their environmental characteristics, and one way of doing that is by packaging their consumer goods in more environmental friendly and recyclable packaging. Apologies for my dogs in the background. Just going to close that door quickly. And then lastly, digitalization, whereby if you think about everything that we do now, it is increasingly digitized. Digital companies are getting increasingly digitized, but even those who once upon a time you wouldn't have thought of as being particularly digital, for example, manufacturing companies, are now installing highly digitized manufacturing equipment. And so it enables them to sort of discover if they're going to have an issue before it happens, by running something called a digital twin. So you can run your factory and you have a digital twin on a computer, and that computer highlights if a part is starting to look a little bit dodgy before it actually breaks, and thereby you can plan downtime, fix that part, and that creates massive savings versus that part actually breaking unplanned for, causing all sorts of problems with your equipment. So that's just a sort of very small example of how companies pushing those types of products across every single really industry out there now, which is becoming increasingly positive. I've covered a wide area, and where I haven't left a huge amount of time for questions in, I know you said you haven't had a huge amount in, but maybe we can move across to Q&A. And so if there are areas I haven't covered, people can.
Will, that was great. Thanks very much for that. One of the things that came up with someone, obviously, you have the 3 core strategies that we use, and you specifically state your fund's objective is to deliver a greater total return than the consumer price index measure of inflation plus X percent. With obviously the consumer price index being dramatically higher than it was, say, 2 years ago. are you having to dramatically increase the risk across your core portfolios to match that, or are you simply waiting for it to come back down?
We're not changing the risk profile of the funds. Look, I think what we've had, as I said, is an almost unprecedented impact on the demand and supply, which has pushed that inflation higher. We think that is something which is going to ease off over time. I don't think the right thing to do is try to chase returns up the risk of the portfolios, to try and meet those returns over 1 or 2 years. These are long-term targets, which we hope to achieve over 5+ years. Now, I think we have to be realistic. If inflation stays at 6, 7, 8, 9, 10% for the next 5 years, we are going to be behind those. But we do think it will come down. But I think the wrong thing to do is to chase returns in the short term. I think that could mean we actually fall further behind by changing how we manage the funds. We're sticking to our knitting, which is looking to compound returns over time, try to protect on the downside. And unfortunately, to say, when you go through a period like this, it is difficult. But I think our clients understand what has happened in the world, how markets are behaving, and are just looking to us to be sensible stewards of their capital. And hopefully over time, returns will pick up and we'll get back to those inflation plus returns. But we're not chasing them in the short term.
Okay. Well, when we have a big shock in the market, last year, obviously the Russian invasion of Ukraine, a number of clients say to us, well, didn't you see it coming? Why didn't you move to cash? So the question, when Russia invaded Ukraine, we saw markets drop. Why didn't you move to cash?
So I think Russia invading Ukraine was one. Well, hindsight is very easy, of course. I have to say, and I'm unfortunately on record of saying I didn't think Russia would invade Ukraine. That was my personal opinion. David was a bit more circumspect, I think. So if we move to cash completely like that, we're trying to time the markets. I think a lot of people, most people are very unsuccessful in trying to sort of market time. We've got a really interesting slide, actually, which I literally had up the other day, which was talking about what happens trying to time the market. I'm just going to pull it up now because I think I've got it here. Here we go. So this is the danger of trying to be in and out of markets. I'm sorry I can't pull this up, so I'm just going to walk you through. But if you invested 10,000 in the S&P 500 20 years ago, it would be worth £65,000. If you'd missed the best 10 days over that period, it would only be worth £30,000. And so I think that highlights that the risk of coming in and out and missing those big up days can really hurt your long-term compounded returns. And so we are not here for us to try and swing in and out of markets and try and time it and say Russia might invade Ukraine, we should go to cash. Actually, if you look, markets rallied significantly after Russia invaded Ukraine. It sold off initially, then rallied significantly. And I think it's actually much more been the Fed hiking rates trying to get on top of inflation than it has been the Russian invasion. Now, of course, you can say the two things are interlinked, which are to a certain extent they are. But, we didn't know what the market reaction was going to be. We didn't know what the sanctions reaction was going to be, of course. And we didn't know, how Europe was going to decide to completely move away from Russian oil over a very short period of time. So as I say, I think very dangerous time markets. We look to position our portfolio for our base case, how we think markets are going to turn out. And then we look to put things around, that to make sure that if we are wrong, we are relatively well protected. And so I mentioned those put options. We had a number of those going into that crisis, which helped protect the portfolio. We had a reasonable amount of cash. So we will always do things to help protect the portfolio, but we're never going to sort of nip in and out and try and time the market like that.
Perfect. Well, we've had a few questions come through on the chat. I don't know if you can
Yes.
see those. I don't know if we can.
Yeah.
Certainly, yeah, we'll make the slide set available. But there was one, a political backlash against renewable energy, back to national energy security, and then another one about your obviously brick exposure.
Yeah, okay, no problem. So where should I start? I'll start just on the brick side. So, we are a global portfolio, and we will consider emerging market investments, but we generally invest direct, albeit we have some funds which have exposure to emerging market debt. We didn't have any exposure to Russia. Going into that crisis, no equities, no bonds. We had a small element of Ukrainian bonds in our emerging market debt portfolio, but I think that would have been absolutely tiny and have minimal impact on the overall portfolio. For us, looking at the BRIC, I guess we have one investment in India, which is a bank which is held in the higher risk portfolio. And that is a play on sort of, Indian GDP. I think banks are the most sensible place to play that. China's probably the big one out of the BRICS, so where historically we've had, a fairly large amount of exposure. We actually reduced that in early 2022. We were just getting a little bit worried about the increasing intervention of China, and also around, the longer term, where they were going to go with their COVID policy. So we benefited relatively well from that in 2022. We still have a few names with exposure there, things like Tencent, which you may be familiar with, which predominantly is a gaming company, albeit it has lots of tentacles into other areas of the Chinese economy. We had a business called Travel Sky, which we actually sold, and then we have a company called AIA. So these are businesses that are listed on the Hong Kong Stock Exchange. AIA, again, you might be familiar with. It's very similar to Prudential in the UK. It sells life insurance across the Asia Pac region, predominantly in China, and so benefits from the sort of rising middle classes in China. So I think, we do have exposure to certain areas. We try to sort of cherry pick that through companies that we have. The other point is we've got Western companies with big Chinese footprints, things like Estee Lauder, which is, of course, the other way to play it, things like Nike. So sort of consumer goods companies selling into Asia and selling into China, and things like LVMH as well. So there's sort of two ways of playing it, both direct and indirect, and we will do both.
Perfect. Will, just in case we're out of time, it's always a question, about currency. Where does the pound go from here? Where does the euro? Where does the sterling? Our clients have assets in multiple currencies and are always looking for help, guidance, long-term predictions. I know you can't, but what are your thoughts?
Yeah, currencies are extremely difficult, particularly in the short term. I mean, for us, when you look on almost any metric, sterling, certainly versus the dollar, looks relatively cheap, and the dollar looks relatively expensive. The difficult thing in the short term is, you've had a couple of issues around Silicon Valley Bank, around Credit Suisse, think markets slowing, a little bit worried about recession. If we go into a global recession, if we have any kind of crisis, the dollar is always a fantastic asset to hold, because typically you get a flight to safety, and that involves a flight to dollars, yen, Swiss francs. And so we like to have dollars in our portfolio, but I do think increasingly it has looked a bit expensive, and hence we've had quite a large part of the dollar hedged. I think we put an extra hedge on about 116 versus sterling. We're now 123. I think the likelihood is, if we don't see a material crisis, is that sterling drifts higher, and particularly under a more stable hand of Rishi Sunak, who appears to be, making some progress around, Brexit with the sort of Windsor Agreement. I think that could just push sterling a little bit higher over time. As I say, we're up to 123. Clearly, as I say,
against the dollar and the euro.
Against the dollar and the euro, I mean, the euro has been a tricky one. I think for me, the big thing with Europe is they had a warm winter, and I can't say how important I think that was to the European economy. You know, if they'd had a cold snap because of the problems around energy, you know, you could have been facing sky high bills, and I think that would have weighed heavily on the euro in the short term. In the more medium term, you know, sterling probably looks a little bit cheap against the euro, but it's not in the same manner as the dollar. So I think it's probably more difficult to call on that side. I've been kind of surprised about the relative resilient strength of the euro, given there is war on the doorstep. So as I say, I think if I'm a sterling investor, I probably don't want to have huge amounts of foreign currency. I think that the risk is we drift a little bit higher. But again, in terms of how we manage the portfolio, we do think it's important to have dollars in the portfolio, which we do. We have hedged out the majority of our euro exposure. That's an easy decision for us because we get paid to do it.
Does it concern you the West's sort of keenness to prolong the war in Ukraine?
Yeah, I don't want to get too political, but yes, it does. It does concern me that, you know, you've always got to be careful in these areas because there is an emotional level on this as well. You know, people can feel quite strongly about these things. But for me, if there is an opportunity for peace, it would be nice to see that. And it doesn't look like there is the appetite for that in the West. It does look like it's becoming, you know, semi-entrenched. It does appear to be part of a sort of larger proxy war. So it is non-ideal, and particularly around the sort of food security point, because Ukraine has historically been so important, you know, to Europe in particular, you know, being a breadbasket of Europe. So yes, the short answer is it does concern me that, you know, this could be ongoing sometime, and it's quite difficult to see a way out. But then, you know, you've got a US election next year. You know, our big issue when we were looking at this is you had politicians who were extremely weak. You know, Biden is very, very weak. I mean, Rishi is marginally stronger than somebody like Truss. And even Boris was under a lot of pressure, of course, and it's easy to then fly out to Ukraine, stand next to Zelensky and look like a strong man and try and, you know, strengthen your voter base. And of course, you know, perhaps that's where Biden's view is that, you know, well, you got problems at home. Maybe it's not the worst thing to have, you know, an ongoing war. But I honestly, I couldn't say if that plays into it.
Look, Will, I know we only had you for an hour, so just on behalf of everyone who attended, I'd like to thank you for your time. Thank you for your insight. If any of the attendees have any other questions we didn't manage to cover, please get in touch with your advisor, and we can liaise with David and Will and maybe get you some specific answers to your questions. But on behalf of Abbey Wealth, I would like to thank everybody who took the time to attend, and once again, a big thanks to Will for stepping in at the last minute. Thanks, Will, and we'll see you again soon. Thank you.
Thanks for having me.